Welcome, everyone. We're back for our live market commentary. And this is where I talk about the latest developments in the market. And this is where we also share our thoughts about them. So I will be your host today, Albert, and I'm the Deputy Country Manager in Malaysia. We're joined today here by Stephanie, who is our Chief Investment Officer. Hi, Stephanie. How are you?
Hi, I'm good. Hi, Albert. Hi, everyone. In fact, I just returned to Hong Kong from my trip in Malaysia and Thailand. So it was great to see you in Malaysia in real person.
Yeah, to our audience out there, if you had the chance to meet Stephanie in Malaysia or Thailand, I hope you found it was a good session. Last week she shared her thoughts about markets, interacted with some of you, I'm sure. So yeah, it was interesting times now that borders have opened up. But anyway, it's been a while since we did our last market commentary back in December. January itself was a pretty jam-packed month with other events. But I guess similar to before, today I would like to focus on two things. One is the on US itself, and the other one will be on China. And as this is a live event, please feel free for those who are watching this from YouTube, please post your questions. There is a Slido link in the YouTube the YouTube description itself. So just go there, go to Slido and key in your questions based on whatever thoughts that Stephanie will be sharing. Okay, so on to the first point, which is about the US. Last week we saw quite a few things happen. We had the 25 basis points hike in interest rates, which was expected by the market. Jay Powell, in his press conference, didn't really push back against, how exuberant the market was in terms of loosening financial conditions, and this somewhat led to markets kind of being very excited, and we saw it move up quite a bit. And towards the end of last week, on Friday, we also had strong economic data in terms of the non-farm payrolls. We also had average hourly earnings also, all beating expectations. And lastly, yesterday night, we had Jay Powell at the Economic Club of Washington. That's where he gave his thoughts, and he mentioned that, we're at the beginning of a disinflation stage, and further rate hikes will be needed if we see a very strong labor market out there. So my question to you, Stephanie, is, given all this that's been happening, what do you think about higher rates this year, given the backdrop that we're in? And that's the first part. And the second part is, we have been on a year of higher interest rates, especially coming out of the US. So markets are expecting a recession. Are we then likely to see a rate cut coming in the later half of this year?
Yeah, it's all a bit confusing. I think the messages that we got last week from both the Fed and also from the data release on Friday in terms of the labor market. So, let's take it kind of one by one. So I think before last week, of course, the markets have rallied in terms of both bonds and equities. If you look at bond yields, they've come off quite significantly over the last kind of 2 months or so. And that's because the market has been increasingly pricing in a soft landing scenario where inflation is coming down, but also growth is not as bad as feared. And that's because if you look at US CPI number, it has come off the peak. And when we kind of last discussed this trend, I think we were in the same camp saying that, inflation should come down. But also, the market participants and ourselves included tend to look at a moving average. So you need a few months of data to confirm a change in trend. So I think what the market got was, over the past few months, there has been a change in trend, and that, inflation seems to be a worry of 2022. So as we have said in our market outlook as well, we think inflation concerns would mostly be, I guess, more subdued this year. But this year, the focus of the market actually returns to growth. And so the market has kind of concerns have been gyrating between, are we going to get a soft landing, or are we going to a much harder recession? And this is guided by different types of data. So I think if you look at the range of growth indicators or data that we can look at, there are some leading indicators and there's some lagging indicators. So in terms of leading indicators, for example, one of the best ones that we also like to look at a lot is the PMIs, the Purchasing Managers Index. In the US, it's called the ISM, Institute of Supply Management Index. And that, typically leads the economic cycle because it's basically a monthly survey of the purchasing managers in the industry, in the supply chain. So if the economy is strengthening or weakening, they would be the first ones to feel it. And every month, basically, the ISM, for example, asks these purchasing managers or asks these participants in the supply chain, how do you feel about the current economic situation, and how do you think about the future situation? Do you see inventories rising? Do you see prices rising, coming off, et cetera, et cetera? So, this actually gives a pretty good leading indicator of where the economy is going. And when we look at this indicator in the US, it has been going down in the past few months. And recently in December, it actually crossed the 50 line. I.e., when this ISM number is below 50, it means that the economy is actually in a contraction. When it goes above 50, it means that the economy is expanding. So then, we all know that the economy is actually slowing down. And if you look at the US manufacturing ISM, it's actually slowed down to a level which is quite alarming. So compared to the last time when we had such a big slowdown, that was actually back in 2020. When we had the COVID, stopping of the economy and preventing people from going to work. So, on the one hand, this data has been quite alarming. On the other hand, on Friday, we got the payrolls data, right? Payrolls actually was a blowout. The consensus or the market was looking for around 300,000 increase in non-farm payrolls. The actual number actually came out to be 510. So that actually beat consensus quite a lot, and unemployment rate is actually at all-time low. So you may ask, why is there such a big difference, right? One piece of data is telling us the economy is actually contracting. The other piece is telling us it's quite strong. So when we look at the different types of data, some is leading, some is lagging. And from our analysis, actually, the payrolls data is quite lagging, i.e., if you think about companies, people tend to be the last cost item that you cut. Like, you try to keep your employees as long as possible, as your business can still sustain. So that explains why payrolls is still so strong, while we're already seeing the leading parts of the economy falling into a contraction. So that's kind of on the growth side, and the market reacted quite nicely to it. One more reason is because of Powell's more dovish comment. I think the market going into the Fed was actually looking for Powell to be quite hawkish. Actually, if you look at Powell's actual comment, he didn't say much new, right? He didn't say, "Oh, we're going to stop hiking rates." In fact, yesterday he said we may have to take interest rates a bit higher than what we already penciled in. So if you look at the Fed's own projection, they're projecting two more, sort of like a 50 basis points more rate hike at 5.1, and then basically they project to be staying at 5.1 for quite some time. The market is actually saying that the Fed will hike interest rates, but not as high as the Fed projects, and then they will actually start cutting interest rates in the second half of 2023. So quite soon. And that explains why, I guess, we see equities and bonds rallying. If we look at this scenario, it's actually quite an optimistic scenario in our view, because of the lagging nature of the payrolls data. So I think if we're looking at some lagging indicators, it's not that useful for putting together portfolios or indicating kind of forward asset price performance. And we're seeing like different parts of the economy already slowing down. So I think net again, Powell being a bit more dovish means that high inflation may stay for a bit longer, even though it has peaked. But also, if interest rate stays a bit longer, then the risk of a deeper contraction also increases. So I guess that the last week, a lot of things happened, but net, we think that doesn't kind of change our view that still a much lower risk, a much lower growth scenario remains the biggest risk in 2023.
All right. So that's for the US economy aside. But also, I guess on the back of it all, there's another interesting thing happening on the other side of the world, which is China itself. So there's been a lot of, I guess, people happy about China reopening. In terms of economic numbers, we have also seen their manufacturing and services PMI, which went from below 50 to above 50, signifying an expansion. We are also coming out of the Lunar New Year from China, so that's where the economy kind of pretty restarts again. So given this whole reopening from them, the positive spill over to trade partners like in the Southeast Asia or even Europe, could we avoid a recession or even a soft landing that you talked about earlier, and instead, things won't be as bad as feared?
Yeah, I think if again, we like to look at the data, and China also has its own PMI. So if you look at the PMI, indeed, as Albert mentioned, it has climbed above 50. So it means that the economy actually started expanding. However, it's also quite choppy in the last few months. So if you look at a kind of 3-month average, it's still below 50. I mean that it's, we don't have a clear signal that the trend has changed. Having said that, however, of course, we've seen a lot of policy coming out from China, including the reopening, and also, I think more importantly, we've seen sort of relaxation in some of the tightening policies. For example, for the property sector, and then also they injected quite a lot of liquidity into the whole system. So this is in contrary versus the US. And I mean, that was one major reason why we kind of upgraded our view on emerging markets, including China, in our December reoptimization of the portfolios, like to bring it kind of more market weight. I think if you look at the implication of China's recent policies and reopening, I think it's quite likely that we've seen a trough in terms of China's economic growth. However, to have a sustained kind of uptrend, we need stronger kind of, growth drivers from different industries. And I guess from a growth perspective, if you think about China in the past 2 decades or so, property actually contributed 30% to GDP every year. And then obviously in the past few years, internet was also a big kind of growth driver, and they employ a lot of people. The structural change is that, I mean, China cannot afford to stimulate property again. And also, given the policy kind of focus on the internet sector, it's very, very hard for us to envision that the internet sector will grow as it has been in the past decade. So, I mean, with these two kind of big growth drivers more muted going forward, we need to see some other growth drivers emerging from China. So far, I guess, I mean, there are a few potential ones, but we haven't seen like some very, very strong support for any particular kind of sectors that could replace these two. So I think all in all, we think the trend is positive. I mean, we may see kind of PMI climbing further up in the next few months, but it is just strong enough to support the global economy, or like even prevent US from going into a contraction. I think that's not very likely, unless, I mean, China goes on a bazooka, right? Unless they just kind of stimulate the property market like how they did in 2009. So I think given the policy constraint, it's very, very hard to see that happening again. China's focus is actually on risk mitigation. They don't want the sector like property, for example, to go into a systemic risk, because, I mean, then it touches on the banking system, which creates a much, much bigger systemic problem for China. But they're not going to just kind of stimulate blindly, because they know the price that they will have to pay in the future. So I think, yes, it's relative to the US is in a better place. But also, I mean, just bear in mind that the equity prices in China related kind of sectors have rallied quite significantly. For example, you look at the Hang Seng, it's rallied 50% from its low. So in terms of just kind of valuation, it has rebounded quite a lot, and I think that incorporates the hope that a reopening would bring in kind of the economic recovery.
On that point, actually, before that, if any of you have questions, I see some questions streaming in already on Slido. But if you aren't aware, there is a link to Slido in the YouTube description. So please feel free to post your questions, and we'll get back to it in a few moments. But yeah, on the whole reopening on China itself, Stephanie, do you foresee any risks from that? I.e., if inflation picks up again, are we going to be back on a path of rate hikes going forward?
Yeah, so if you look at more recent data like jet fuel consumption in China, it has been going up, and I think this is to be expected because of the revenge travel, right? If you're locked up for a whole year and like suddenly you free up, then of course, I mean you take the plane, you take the train, you go to places, you visit relatives, etc., etc. So I think you need to take the recent spike with a grain of salt. But I mean, having said that, of course, like the China reopening has positive implications for commodities, for oil users, for other like gas, copper, etc. So I think that adds. I think that sort of gives a lot, like a bit more support to these commodities, and if you think about kind of the net effect of a U.S. contraction versus China reopening, some of that would balance out. So I think it lends support to commodities. However, when we look at inflation, it's a year-on-year change, right? So if you think about commodities like oil prices last year, it went up to $120, and I mean it's hard for me to see that a China reopening would actually push U.S. kind of oil prices up there. So in terms of the year-on-year change, we're going to see much more subdued year-on-year change this year compared to last year when we had a Ukraine war. So I guess are we going to see like oil prices going down a lot? I think the China reopening story will support that, but also probably not that much upside. So net, I think commodity prices may more be in the range bound over the coming months. And the year-on-year effect means that the impact to inflation will actually go down.
And just taking some questions from the audience here on the topic of China itself. Someone's asking, who are the biggest beneficiaries from China reopening? Is it emerging markets?
Yeah, I think there are obviously the service industries in China are the biggest beneficiaries because people can then go out and spend, go eat, go travel, and I think if you think about the playbook is basically quite similar to when US reopened, like leisure, like hotel, airlines, and all these sectors kind of benefit. Also, of course, if you think about where the Chinese would travel, I mean, like Southeast Asia is a popular destination. I was actually, just in Thailand last week, and I guess on the ground we're seeing a lot of Chinese tourists returning. And then the other sector could be European luxury brands or European just kind of leisure stocks. So I think, these are kind of more obvious sectors that would benefit from a China reopening. Then, I guess from a kind of secondary perspective, it will mean that some of the sectors from China will have capacity to start going back to work and develop, etc., etc. So I think initially in the first few months, those are the sectors that are worth kind of paying attention to.
All right. Okay. And then I guess switching gears to a little bit more focused on our product offerings, because there are quite a few questions on that. This is a bit more general, but this question says, it seems like economists are divided about whether there will be a recession or not. Are our portfolios positioned in a way to stay resilient throughout the uncertainties?
Yes, actually, that's a great question. And so thank you very much for that. At StashAway, we actually manage put together our portfolios according to something called the StashAway Risk Index, right, which is the maximum like 99 percentile kind of drawdown under different macro scenarios. So we actually reposition our portfolios whenever we see a new kind of macro scenario or new risk kind of emerging. So when we in December, we actually re-optimized our portfolios because throughout, I guess, the second half of 2021 and also 2022, inflation was the biggest risk. And so we've added inflation protection to all our portfolios back then, and that actually helped our portfolios to outperform our benchmarks by around, on average, 5-6% throughout the 2022. Going into 2023, as I mentioned before, we think that now actually economic growth becomes the market's biggest risk, because if you kind of as I mentioned, right, inflation is rolling over. Like, people expect inflation to be on a path to kind of coming off. The question is how fast, right? But on the growth side, there's much more uncertainty. If are we heading into recession? Are we going to a soft landing? So when we optimize our portfolios, we make sure that when we put together different asset classes under this kind of growth slowing down, inflation still high, but it's rolling off scenario, that the worst case kind of drawdown would not exceed our SRI level with a 99% confidence. So that's how we manage our portfolio. So for people who are concerned about drawdowns, I think this is what we've done to make sure that the downside is protected.
Great. And I guess on that point, we've got a question here. I was asking about interest rates. Do you expect interest rates to rise much more? And because of that, should I be adding more to StashAway Simple, which is one of our offerings?
Yeah. So I think in terms of US interest rates, so there will be 2 more meetings, I guess, where the Fed will hike 25 basis points, given what we're seeing now in the data and everything. So the next Fed meeting is in March. So it's the Fed is expected to hike 25 basis points at March, and then afterwards in May, there's going to be a second meeting. And if the Fed hikes another 25 basis points, I mean, that takes the Fed funds rate to 5.1%, so which is the Fed's target. I mean, we think it's quite likely that they will do the 2 times interest rate hikes, and just kind of stay there for a while and observe the data. I mean, in that scenario, I think if you look at Simple Plus or like kind of fixed income products right now, the yield on these products are actually quite attractive. The reason is because when we think about valuation for bonds, you need to compare it with inflation. So, of course, today's inflation is still fairly high. It's kind of around 5 to 6%. But I mean, the inflation, given the Fed's tightening, should come off. And long term, I guess if you think about kind of longer term inflation, around maybe 3% or so, or even lower, a kind of interest rate of 4 to 5%, it's actually quite attractive because you're earning like 1%, 2%, so-called like real interest rate. So I guess, and also secondly, in terms of this year's environment, given all the uncertainty and potential volatility in equities, bonds tends to be a lot more stable, right? We all say, like, I mean, when we talk about bonds, it always sounds very boring because I mean bonds are boring. Bondmans are typically like not the most colorful guys I guess on Wall Street, because I mean that is exactly what bonds provide, right? They provide stability. So I think if you look into your own asset allocation, if there's if there's a more allocation to equities or kind of more risky assets, then I mean this year it's worth thinking about, should I add some more bonds to kind of balance out the risky assets and just build a more diversified portfolio.
Yep. Maybe for those of you who are listening but aren't sure what Simple or Simple Plus is, at least StashAway Simple is like a cash management fund that we offer. Essentially, it's a way to earn a little bit of interest rather than just keeping in the bank and not making your excess cash sweat for you. So that's how you can benefit from it. And if you need to withdraw it at any point in time, there's always that flexibility. So there is no lock-in period. All right. Next question is by this person. He says, I have a flexible portfolio and I have added more exposure to China and emerging markets. However, despite the gains, I guess, from the past few months, the weakening dollar has negated the growth. So what are your strategies on this, Stephanie?
Yes, I think, I mean, depending on kind of your home currency, I guess, like the dollar impact could be big or small. So I'll just say a few things. Number one, renminbi also strengthened against the US dollar, and that also contributed to the increase in the allocation to China in the flex portfolio. Because if you think about even though, I mean, you may think about your portfolio in US dollar, the underlying equities, the underlying companies actually operate in renminbi. So I think for you, you need to think about, if you look at it from a kind of China currency versus your home currency basis, I mean, that it may not have changed that much, because a lot of the Asian currencies move was driven by actually the dollar weakness or the renminbi strength. So it kind of moved in tandem. So you need to take that into account. When you take that into account, actually, the currency effect is not that big. Secondly, I would say that if you have a portfolio that is predominantly home currency, maybe it includes all your assets, right? It includes your house, includes your other investments locally. Then, I mean, having some like kind of exposure to US dollar can actually help you diversify your risk. Currencies tends to be a kind of a zero-sum game. So if you look at like long-term charts of the US dollar, it fluctuates up and down, right? Every cycle, when it's an up cycle, it goes up like 25%. When it's down cycle, it comes back like 25%. So net, over a long-term basis, I mean, the currency fluctuation actually cancels out each other. And because I mean, currency is actually quite different from equities and bonds. Equities and bonds tend to go up over time, because for equities, you're actually earning the economic growth or the earnings growth of the company. For bonds, you're actually earning interest rates. However, FX is basically a zero-sum game. It's one currency versus the other. So over time, it doesn't tend to go up, and it just stays flat. So of course, like within that, there are some big cycles, but I would encourage everyone to think about like the home bias, the home currency exposure versus maybe getting some US dollar.
So that's your Stephanie's view in terms of currency. And I guess the last question, because we're kind of running out of time, which is a little bit more on StashAway as a company itself. So the question is, seems like we are in everything right now. When I presume when this person asks and says that we're in everything, means we have different offerings out there, from general investing portfolios to flexible portfolios. So Stephanie, what is kind of the direction of the company or StashAway this year?
Yeah, I certainly hope we have everything, but I guess we don't have everything. And if I look at like kind of the suite of products that we have, there's still a lot of gaps that we can still fill. And of course, when we first started out in Singapore, like 6-7 years ago, we only had the general investing portfolios. We only had a few products. As the company grow, as our client base grow, I think we have like different client needs that we're trying to serve. So hence, I mean, that's why we've launched Simple Plus, which has been very, very successful over the years for very, very ultra kind of low risk investors. We have thematics for high risk investors. Now we have like Flex for people who like to just kind of do a bit more customization on their own. We also have BlackRock for investors looking for like an alternative to the StashAway managed portfolios. And so I think if I think about like just kind of all the different portfolios, they cater to different risk needs and different kind of investor type needs. But I think central to StashAway is still our ERM managed portfolios. And that's why we're paying so much attention to what's happening in the macro world, in different asset classes, in different regimes, in data, and how to enhance our ERM managed portfolio performance as well. So there's I think there is not a move away from like being very, very diligent on our portfolio management. And in fact, we've expanded our investment team quite a lot by hiring people, hiring senior macro analysts, quant analysts in the team to take care of a portfolio for everyone. So, I think it's a good change, or it's a good kind of evolution for the company to have more like on our platform. But I think we're also increasing our resources so we can actually look after all the products.
All right. So there's a little bit of insight into I guess where we're heading as a company at StashAway. But anyway, that's our time's up. Thank you so much to everybody for tuning in. Thank you for your questions. Thank you, Stephanie, for sharing your thoughts. This is the live market commentary event for February. We will be doing another one next month. So we'll see you all. In the meantime, thank you again. Do stay safe and take care, everybody.
All right. Thank you. And we'll talk again soon.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.